Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to Prospecting for Qualified Plan Business. In our market, we're talking about prospecting to businesses that are closely held, typically with fewer than 10 employees, where the qualified plan really is a personal planning tool for that business owner. Now, how many of these businesses are out there? There are 30 million businesses out there with less than 10 employees. If we drill down to that data further, only 44% of those businesses have any retirement plan in place. That's for businesses with less than 50. Also in that less than 50 marketplace, only 9% have a defined benefit plan in place. If you take that down to the businesses with fewer than 10 employees, those numbers drop even further. They get dramatically low. I know that in that world, only 1% of those companies have a defined benefit plan in place, and way less than 44% have even a defined contribution such as a 401k in place. There is tremendous opportunity in this marketplace. It's really an underserved marketplace because for all those businesses that do not have a plan in place, for many of them, it's not because they can't afford it. It's because they just don't know what to do. They don't know what they can do, and they don't know what they should do. Combine that, let's look at our baby boomers. We have 80 million baby boomers out there, and they're all going to need some kind of retirement security. There are some scary statistics out there. This is a statistic from 2007, so adjust this based upon what's happened in the market since then. Dropped considerably, partially recovered at this point, maybe fully recovered. So we'll take these account balances at their face value. But 401k plans have been around since 1981. That means for baby boomers who've been in the workplace all that time, they could have been with companies that enabled them to save in a 401k for the last 30 years. Looking at these balances, these are for people who actually did save. This does not take into account those who did not save. But for those who actually did save, participants in their 50s, the average 401k balance is $127,766. Half of those balances are below $70,000. Now, how long do you think you can retire on $127,000? How about $70,000? Not very long. And I can tell you that my experience is, even though I work with business owners and people who are successful and making money, some people are savers and some people are not. The fact that they're making more money doesn't necessarily mean that they have more than this put away for their retirement. And that's a real serious issue. We are looking at a retirement crisis in this country. And just because you're a business owner doesn't mean you automatically escape. Another issue for business owners is what are they going to do with that business when they retire? Typically, statistically, for a business owner, that business represents 75% of their net worth. So if that business owner has finally come to the conclusion, I think I want to retire. I don't think I want to work till I drop dead. I actually want to retire. How do you transition from being business owner to retiree when 75% of your net worth is tied up in that business? The first step they need to figure out for retirement is what are they going to do with that business? Are they going to sell it? Are they going to give it to their kids? Are they going to keep working? Are they going to shut it down? All those things have to be figured out. If they don't make a plan, some succession plan for that business, you know what happens when you don't plan. Life takes care of it. It's in its own way, and you never know what's going to happen. And a lot of these businesses never make it to the second generation because of a lack of planning. Especially should that business owner die and estate taxes are due. You have all kinds of issues as to where the family comes up with the cash to pay those taxes. So sitting with a business owner, they're sitting there, you're having a conversation, they would like to retire. So the next question is, what is your plan for retirement? Well, When they answer the question, I don't know, then they really don't have a plan. But most of the business owners will tell you their plan is to sell their business. And that's a great plan, so long as you can find a buyer. What happens for business owners who wanted to retire in the last few years? Might they have had trouble finding a buyer? What about finding a buyer that could come up with financing to buy the business? These are real genuine issues, and they happen in the real world. And so if that business owner cannot find a good buyer at the time that they want to retire, what are they going to do? They're faced with a very difficult decision. Do you sell the business to anybody who can buy it and just take whatever you can get, even if you think that's a fraction of what the business is really worth? Or do you say, I'm not going to retire now. I guess I'll work a while longer, and maybe 10 years down the road, maybe I can find a buyer. And you just hope you don't die in the meantime, and you make it and you get to retirement and still get to enjoy your retirement. It's also an issue for people who plan to give their business to their children. Their children are taking over. Where does that child come up with money to buy that parent out? You can't go to the parent and say, could you loan me the money so I can buy you out? All those are real issues that business owners have to deal with. Now, if they had set up a qualified retirement plan along the way that can help alleviate some of the pressure by getting some money put aside before the day of retirement, so you have that money there. And you could accumulate money in a very tax-advantaged way. Those are all good things. Tax-advantaged, protected from creditors, set aside where nobody can take it away. So when the time for retirement comes, now, as the business owner, they can look for a buyer, but the pressure's off if they've saved enough. They find a buyer, great. They've got the money from the sale as well as what they saved in their retirement plan. They can't find a buyer at the moment. They've got money in their retirement plan, so they have choices. They can choose what they want to do, and hopefully maybe even hold on to that business a little longer, or the equipment in that business, until they can sell it sometimes later on. It gives them a lot more flexibility and a lot more choices. How much money might they have? Depends what kind of plan they had and how long they had it. In defined contribution plans, they could have been contributing 25% and deducting up to 25% of the payroll for the participating employees in every year, maybe receiving about $50,000 each year for themselves. Depends how many years they've had the plan and how they've done with their investments in the plan as to how much they might have left. Or they might have put in a defined benefit plan, had much larger contributions, and under the current rules, they could have accumulated somewhere between $2.2 and $2.4 million as a lump sum. That number varies with the current interest rate, but it's been hovering in that range. That would be available to them for their retirement. That's a nice chunk of money. May or may not be enough for their lifestyle, but it's certainly a nice step up to get them ready for along the way. Now, besides the retirement planning, why would you do the plan now? Well, because it's all tax deductible. Get the tax savings now. It's always good to save taxes. People always feel good about saving taxes. CPAs are always positive about saving taxes. So in good years, that business owner having a good year, let's make a contribution to a qualified plan instead of either putting all that money back into the business, paying a big chunk in taxes, maybe taking some money to buy some nice toys for yourself, but take some of that money and put it aside, get that protection, get that savings so it's there for you later on. That's what a qualified plan can do for someone. In the current, great, got that feel-good feeling about saving tax dollars, CPA's happy, the employer's happy, and they're saving for the future. So who's a prospect here? Those are all good things to talk about the first time you meet with a business owner. So who do you want to talk to? You want to find a business owner who's successful and paying taxes. They're going to like the appeal of the tax deductible plan contribution, saving taxes, putting money away that's going to be theirs to use later on, puts more money in their pocket. They can be any form of business, doesn't matter here. Sole proprietor, partnership, LLC, professional corp, C Corp, S Corp, doesn't matter. Any business gets the same plans, same opportunities. Typically, these employers will have less than 10 employees because the bigger the group of employees, the more we have to kind of give money away to the employees and not put it in the owner's pocket. So typically, these plans have 10 or fewer employees. That is the sweet spot. They'll like the appeal of the current tax deduction, gives them annual tax savings, and we want to be able to design that plan so the tax savings for each year exceeds what they have to put in for the employees. That's why we want less than 10 employees, so that the money is really going, the bulk of it is going to work for that business owner. Nice piece for the employees. They get the goodwill there too, but most of it's going to work for the business owner. If they have a life insurance need or want to guarantee that the plan will be self-completing in case they don't make it, you can have life insurance in there, all paid with tax-deductible dollars that are plan contributions to pay the premiums. Obviously, that knocks about a third, sometimes more, off of the cost of the insurance, makes it a cheaper place to buy it. They may have this interest in saving for retirement. It used to the conversations about qualified plans used to always be about the tax deduction. These days, with all the baby boomers, a lot of conversations about saving for retirement. It's on people's minds. Again, if they did a defined benefit, they might be able to save as much as in excess of $2 million to have for their retirement. And lastly, protection from creditors. Business owners used to feel that they were invincible. I think not anymore. Everybody knows that things can happen. Businesses can be put at risk even when all has been going well. And that protection from creditors can be really valuable. All the money that goes into the qualified plan, as long as you have one rank and file employee in that plan, will be protected from creditors. No one can get to it. Nobody. The only ones who can access that money is the IRS and your spouse. So where do we find these businesses? Well, you deal with them all day long. They're on Main Street. They're up and down Main Street. Where do you stop to get your coffee in the morning? Where do you take your clothes for dry cleaning? Where do you get your car repaired? Where do you buy your clothes? All those businesses are potential candidates for a qualified plan. All of us talk to business owners all day long. Keep in mind that if it is a pure cash business, the qualified plan probably can't get them a better deduction than what they might be getting now. But there are fewer and fewer pure cash businesses out there as people have used more credit cards and debit cards every day. But also think beyond the traditional businesses. Everybody likes to think about the doctors, the physicians, the veterinarians, the attorneys, that are all architects are another good group. Making money obviously can benefit from the tax deduction, but there are lots of other businesses out there. People driving around in pickup trucks who make lots of money doing yard services and tree services and construction services, those kind of things. On Main Street, don't overlook the little storefront. Sometimes that little storefront has a big internet business behind them, and they may be much bigger than they appear. All of those businesses are candidates. Now, how do you approach them? Great way, if you already have an acquaintance, talk to them, open the conversation. Ask them, would they like to put away money? Would they like to save in their taxes? Adopting a plan holds a potential for tax-favored savings. Getting that money in a protected place away from creditors, reducing your current tax obligation, having savings for tomorrow, and of course you get the benefits of having a cost-effective employee benefit plan as well for the employees who work there. If they already have a plan, great. They understand all the tax advantages of having the plan, but maybe it could be made better. The tax laws change all the time. The pension laws change all the time. They change all the time. The employees who work for them, turnover, change. They may be a growing company. They could be a shrinking company. The business owner themselves, as the years go by, they get older, and certain plans work that to the business owner's favor because they take age into account. All those reasons can create a good reason to take a look at that plan and see maybe it could be made better than it currently is. So what's the nature of the initial appointment? When you get that initial appointment, all you really want to do is get some basic information. And the key here usually is to remove the business owner's fear that it's going to cost them too much for the employees. The idea of the plan is all about getting tax savings, getting money protected for you, for your use, and the plan will be designed around you. It's all designed about you. We'll bring those employees in as we need to or as you want to, but mostly this is going to be focused on you, and we're going to try and get to your personal goals the best that we possibly can within what the law allows. So let's take a look at, here's a sample case. Someone who's making $175,000, puts them in the 28% tax bracket. That means that they are paying taxes every year. Whether they like to or not, they're paying about $40,000 in taxes each year. If they were 40 today, let's say, and they were going to do this for the next 25 years, and nothing's changed. Tax rates didn't go up, their income didn't go up, everything just stayed the same. Take that $40,000, multiply it out by 25, and that's over $1 million in taxes they'll pay over the next 25 years. That's a lot of money. Well, instead, we could put in a plan, get the current tax deduction pulled back, that tax savings, and put it to work for you. the business owner. In my little example here, if they put $50,000 away, it would save them $17,000 in current taxes. If they did that for the next 25 years, that would be a tax savings of $425,000. If we showed that going in the plan, we showed it growing at 5%, we don't know what the return is going to be. Could be less, could be more. I don't know. We're just using an example here. But at 5%, that would accumulate to over $800,000 over the next 25 years. So would you rather spend the $425,000 in taxes, or would you rather have $800,000 for your retirement? What would you like to do? Usually not a hard decision. Now, to get that tax savings, we really put $50,000 a year for this person into the plan. We played that out of 5%. Maybe they'll have more than $2 million for their retirement. So, again, it's a simple question. Would you rather keep paying the taxes over the next 25 years, if everything stays the same? Here is $425,000. Or would you rather maybe turn that money around, put it to work for you, and maybe have more than $2 million for your retirement? So some common questions and objections that they'll come up with. One is, but don't I have to make contribution for my employees? And won't they ruin my ability to save efficiently? What they're really saying is here is, I'm going to have to give too much to the employees. Another way to say it, I don't want to contribute for my employees. I already pay them enough. Another way they might ask is, how much do I have to put in for my employees? What are they going to cost me? Those are all real objections. That's what's on people's minds because they're thinking, that business owner's thinking about the dollars. Well, if the plan works efficiently, those plans may not cost anything. And it's perfectly fine. Answer the employer with that. I understand your concern about your employees, and I understand you can't afford to put in for them. You're not looking to put money in for them. But in fact, not having the plan could be costing you more than having the plan. Well, how could that be? If the tax savings we can get for that employer are greater than what has to be put in for the employees, they are going to come out ahead. On slide 23 here, we have a little sample case. We have two owners, both making $250,000, and we have two employees who work for them. We put in a plan here. We made a profit sharing. It's all about efficient plan design. This is a new comparability profit sharing plan, which will favor them. $50,000 for each of the owners, but we only have to put in $4,500 for the other two employees. So out of the $104,500 contribution here, 96% is for the two business owners. Now, if we look at what that means from tax savings point of view, in the after-tax analysis on slide 24, we assume this employer is in a 40% tax bracket, state and federal. At a 40% tax bracket, by putting in the plan contribution of $104,500, they will save $41,800 in taxes because of the deduction, meaning the net after-tax cost for this plan is $62,700. The two owners are getting $50,000 each, or $100,000, so they come out ahead $37,300. The plan cost them $62,700, but they got $100,000. So what did the employees cost them? They really didn't cost them anything. Did they contribute for them? Yes, they contributed $4,500, but that was paid courtesy of Uncle Sam. Of the tax savings, the $41,800, a piece paid for those employees, and the rest went to benefit the two owners. This plan definitely comes out ahead. Keep in mind, if they didn't do the plan because they don't want to give that money to the employees, or for some other reason, that cost them $41,800 in lost taxes that they will have to pay. So it's really a simple question. Would you rather contribute a little for your employees or pay a lot in taxes? Which would you rather do? It's not so bad to give money to the employees. So common questions and objections. Can the plan cover just certain employees might be their next question. Can we exclude some employees? And the answer is yes. It depends on your group though. First, we have eligibility requirements to get into the plan. Then we have coverage rules about who has to participate, but it allows us to have people who don't participate. And then lastly, employees who get in the plan, their benefits can be on a vesting schedule, so they have to stay with that employer a number of years to actually own those benefits. So we don't want to get into all those rules in the first conversation with the business owner, and we'll get into these rules in more detail in others of these training WebExes. But in answer to the employer's question, can we only cover certain employees? Within the rules, we will work to exclude or favor whichever employees you choose. We just need you to tell us who you want to favor and who you don't, and we will do our best to get to that objective. Here's some more common questions and objections. I want employees to take some responsibility for their own saving. fine. If that employer has that on their mind, we can put in a 401k component in that plan, which enables the employees to save as well. Can I just cover my employees in my one company, but not in my other company? It's not uncommon. We find business owners that own two companies. The answer to that is maybe. We don't know. The coverage test can allow us to exclude employees, and we may in fact be able to do just what that employer wants. We don't know until we look at the census data for each of those companies and look at it together and run the tests. But we can try. So in a perfect world, you're on that first appointment. What do you really want to accomplish? What you want to walk away from that appointment with, first of all, is a fact find. For every employee who works there, we need dates of hire, dates of birth, and salaries. And the key things that you want to ask that employer is, how much do you want to contribute? They may answer that in terms of how big a deduction they're looking for. Either way will do. Which employees do you want to include? And which employees do you want to favor? We can take that information along with that employee census and go to work on design and try to come up with a plan that will get as close to that employer's objectives as possible. So remember, we're always here to help you. You get that information, call us, send it to us, and we will get to work on that design and see what we can do for that employer and hopefully achieve their objectives. There's no cost to them or to you for us to do that proposal work. We move forward, we'll help you in that sales process, and we don't take a commission split. That is all yours for whatever you sell, and hopefully everyone comes out a winner. Thank you. Thanks for attending this webinar. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.